Let me ask the question that I saw in so much research and reading over the weekend. The confidence that the Fed can move the balance sheet back to normal down the road. After this pandemic, after a number of years of return to economic growth, how do you get the genie back in the bottle?
Well, Tom, thank you for that question and enjoy doing your show as always. First and foremost, I think we have to recognize that we're in a really unique situation. The coronavirus pandemic is taking a tragic human toll in the U.S. around the world, and we've asked people to step back from economic activity, investing in public health. And so there's going to be a hit to economic activity, and what the Chair Powell and we've indicated is we have put in place these lending facilities under our authority to act under unusual and exigent circumstances. It's an ambitious and entirely appropriate, aggressive, and forceful use of monetary policy in these times. But to your specific question, yes, I'm very confident that as the economy recovers from this hit and begins to return and recover, that we at the appropriate time will be able to unwind these programs. You know, Tom and Mike, there's nothing fundamentally wrong with the U.S. economy. It came into the year in a very strong position, both in terms of employment and growth and financial markets, and I'm confident we can get back there, and at the appropriate time, we can scale back these programs.
Let me follow up on that, Dr. Clarida, and ask you this. With probably billions of dollars in loans out to companies at near zero for over 4 years, are you ever going to be able to raise interest rates again, or are we looking at essentially the Fed doing yield curve control now?
Well, right now we're not doing yield curve control. What we indicated in our March statement is we're going to keep rates where they are, which is basically very close to zero, until the economy is on track to achieve its maximum employment and price stabilities. And so the path of the economy is going to dictate ultimately the path of rates. But in terms of our programs, these facilities will be in place during the period when the economy is being impacted by the virus. In the term sheets for these programs, you'll see that the facilities are due to stop lending in September of this year. Obviously, we can extend that as needed. Those loans will be in place. They'll have a term of several years. And no, at the appropriate time, I do not think that we will have that will be a challenge to us when it's appropriate. But again, that's a long way down the road. We think where rates are now is where they need to be, given where the economy is.